Let's talk about the S&P 500, a quality index, maybe the premier index as far as I'm concerned. There are at least three ETFs that you can buy that emulate the index. SPY is the old granddaddy. Inception date 1993 is also the most expensive. VOO and IVV are identical from Vanguard and iShares, considerably cheaper. And RSP is an equally weighted um, 500 index from Invesco. So you have market cap weighted ones like SPY, VOO, IVV, and an equally weighted one called RSP, and I'll walk you through the results of each of these in addition to obviously describing how the index works. It's very important as an investor to fully grasp why the S&P 500 is very powerful and essentially market wisdom at work. Welcome to Passive Income from Equities, my relatively new channel. My name is Skip Kapoor, and the style of investing I practice is called enhanced equity investing. I'll walk you through how the S&P 500 index is constructed and give you some idea about some of the principles behind it and the constituents, the companies that make it up and why they make it up in the way that they do. Uh, the index was created in 1957. There were mutual funds available shortly thereafter. The first ETF was SPY in 1993. The longest results I could get from Dividend data was from August 1st, 1995, and $10,000 invested in 1995 would have gotten you 161, a 16-fold increase over around 30 years or so. Um, the criteria by which companies get into the S&P 500 are both elegant and simple. First, there's a market cap minimum. These are by most definition in the large cap plus category, so 18 billion plus. They also want to make sure that there's adequate float. So the formula is called float adjusted liquidity ratio, and basically they want to make sure that there's at least a 75% ratio in terms of annual dollar value traded versus the market cap, essentially making sure that the shares are liquid. 50% of the shares must be available to the public. They can't be controlled by insiders. The company must trade on a major exchange. There are 13 exchanges in the United States. It must trade on the more important ones. It must have been a public company for at least a year. And one of the criteria I like a lot is the fact that it must have every company in the index must have positive earnings both in the most recent quarter and cumulatively over the last 4 quarters. Well, what kind of companies make up kind of the leaders of the pack under this criteria? And essentially, you can see Microsoft, Nvidia, Apple, Amazon, Meta. There are two classes of shares of Alphabet, so they make up 2 out of the 10. Berkshire Hathaway, Eli Lilly, Broadcom. You can see that it is market cap weighted, so it's based on the value that shareholders are giving to these companies. So Microsoft and Nvidia and Apple are close to 20% of the entire index. Out of 500 companies, 3 of them are making up 20%, right? So it's concentrated. The other thing to keep in mind, and the brilliance of this approach in the design of the index is look at the years in which these companies joined the index, right? So as a dumb investor in the index, you didn't have to do anything for Microsoft to join as early as 1994 or Nvidia in 2001, Apple in 1982. So this is why you get the results that you do, because these companies tend to join early as the market recognizes the performance of these companies, bids them up in value, and they squeeze into the 500, and the weaker companies drop out of the 500. There are 11 sectors. The index covers all of them. Real estate is the smallest at about 2.1% along with materials. You can see the heavy emphasis on information technology. And again, that's simply because of market cap weightage. Now, here's the interesting thing, right? So is Amazon a technology company? Maybe, but it's not categorized as such. Neither is Meta for that matter, right? So if you really look at technology, the 33% official percentage of information technology is actually, in my view, understated. The S&P 500 represents 75% of total US market cap and 40% of the global market cap. 40% of the revenues come from overseas. So these are global companies which bring in a very fair share of revenues from overseas. So when you are invested in the S&P 500, yes, there's a domestic bias, but you are participating in global markets. And it has certainly influenced my decision on what percentage to own overseas, and it has quite frankly reduced that the more I came to grips with this 40% number. Hendrik Bessenbinder, and I'll cover that in a subsequent slide, had a very powerful study that he had done. He's with Arizona State University, that 4% of companies provide most of the returns. This is the reason the S&P 500 is successful, because the results are very asymmetrical. Very few companies provide most of the returns. It's very difficult as an individual investor to know which of these four companies are going to make it. And as an index owner, you get to participate in the gains, just like I showed you earlier with Microsoft joining in 1994. So great companies are added automatically based on market cap. And so when the 501st company gets into the 500, one of the existing 500 drops out. So weaker companies drop out, stronger companies get in. The index is concentrated, as I talked about the index being established in 57. VOO and IVV are cheaper, and RSP is an equally weighted ETF. It's close to S&P 500 performance and probably something that people should consider owning along with like an IVV or VOO, so that you get the benefits of diversification without giving up too much in returns. The longer you own the index, the higher the odds. This is true for anybody who fully grasps that time in the market beats timing the market. If you're a long-term investor and you buy the index, the odds are, in let's say for 1 year, there are 74% odds, far larger, far higher than those operated by any casino, which are typically money-making, money-guaranteed machines. When you get to 5 years, the odds are 89% in your favor. And once you get to about 16 years, they're 100% slam dunk odds. So the longer you own the index, the better. So if you are going to buy the index, don't interfere with compounding. Don't interfere with the magic of the marketplace. When it comes to investing in general and equity investing in particular, nobody should be talking about guarantees. You should be talking in terms of odds and the odds in your favor. And there is, just like in life, the factor of luck, right? So S&P 500 returns can vary and quite significantly. So it depends on what your luck is to some extent, not fully, but to some extent during your working years, right? So from 1928 to 1941, your annualized returns were 30 basis points a year. My working years were in the period 1984 to 2013. So I went through getting the 15% annualized returns, which are fantastic because you're compounding, you're doubling in 5 years. Then a period of 6 years, the tech bust and the financial crises where there were negative returns. The only good thing is that if you were working like I was and employed like I was, you were able to buy cheap every paycheck, like because most of my 401k was in S&P 500 type instruments. And then from 2009 till 2023, It's been slightly above the long-term average of 10% or so. So it was 11.3%. So odds and luck both make up the results that an investor gets. Let's get a sense for what concentration actually means, right? So if you look at the market cap of some of the larger companies, Apple 3.2 trillion in mid-June 2024, right? Microsoft 3.3 trillion. Now contrast that to the bottom 406 companies. So the bottom 406 companies cumulatively had a market cap below 100 billion. That's 132 of Apple. So that should give you some idea of what it means when somebody says this index is concentrated. So when you're buying the S&P 500, you are banking on the strongest companies and the valuation of the strong companies and the continued performance of the strong companies. The reason I don't worry about it is because it's automatic. If Apple starts slipping, whatever the next big thing is will take its place. So that's the reason I'm not too worried. Just for perspective, Apple alone has a larger market cap than each of the market caps of the stock markets of India, the United Kingdom, and France. Like it beats each of these individually. I wanted to give you a sense for what brings up the rear of the S&P 500, just so that you got some more perspective. So the bottom 56 companies out of the 500 or 502 that make up the index cumulatively make up less than 1% of the index. So like 1/7 of Apple's holdings alone in the index, right? And what kind of companies are these? Biorad Labs, never heard of them. Mohawk, the flooring company. Paramount, Fox, and News, all media companies. It gives you some idea about how media stands in terms of valuation. But I just wanted you to know that even these rather big names, when it comes to market valuation, don't really account for much. This next piece of information, this slide, is paramount, crucial, critical, fundamental, choose your word, to understanding how the S&P 500 works, or even more importantly, why it is successful. And this is work done by Ben Carlson at Ritholtz and Dimensional. And what it's showing is that the index always, always contains the next big thing automatically. So what it's showing is the performance of companies before they hit the top 10 on the left. So 10 years before, the average performance is 11.8%. And you can see that 3 years before they hit top 10, they're skyrocketing towards 27.2% annualized performance. Once they reach the top 10, they start degrading in performance, and then the next set of companies come into play. So this is at its heart what market wisdom at work means. That companies, as they become successful, get discovered by shareholders who bid up the value. Therefore, their performance goes up. They become a top 10 holding of the S&P 500, dragging the S&P 500 performance upwards so that ordinary investors like you and me can participate in those gains. And then as the trend plays itself out and the next new thing comes in, the cycle repeats itself. It's fundamental to understand how automatic this is, how unpredictable this is, and how routine it is. It's going to just keep happening. It's like mean reversion or Pareto or gravity, any powerful principle. It just happens because it happens, and it's automatic. And this is fundamentally market wisdom at work. We just talked about market wisdom at work and top 10 constituents. Let's take a look at the actual companies so that you get a sense for how the evolution looks like, right? So in 1960, the top valued, the highest valued companies were AT&T, General Motors, DuPont, Exxon. You get the drift. They, these were companies that were making hard stuff that you could touch and feel and so on and so forth. And just take AT&T as an example of how it went from 1 to 2, stayed at 2, then went to 4 by 1990, and ninth by 2010. And that is when dummy investors like me, individual investors, started buying, right? So I've owned AT&T since probably 2013, 2014, and I've nothing to show for it. All I've gotten is some dividends and no capital gain. So when I ended up selling it, I actually lost money. And this is the reason why, because I was trying to be an individual investor, trying to come up with criteria and not fully grasping that the Apples and Microsofts and Amazons and Alphabets were what were gaining in value and in total return. So, the S&P component of my portfolio was participating in those gains, and therefore, yeah, I was saved. But this is why, as individual investors, you're almost always not getting on board the high performers and looking at the rearview mirror. And secondly, we compound that mistake by buying Apple when it's hit number one. And just like I showed in the previous slide, over the long term, Apple is going to get replaced by something. We just don't know what it is. So this should give you a pretty good idea of how the composition of the top 10 companies evolves. And it evolves in a slow, sure way that cannot be stopped. This next piece of information has had a profound impact in helping people understand how the S&P 500 has been able to excel in total return. So Henrik Bessenbinder from Arizona State University did a study which was quite frankly eye-opening, earth-shattering, and so on. And what he found was that going all the way back to 1926, just 86 stocks out of thousands accounted for half of all wealth creation. Now, if you understand Pareto, and I really believe in Pareto, this is not shocking, but it is nonetheless surprising even to people like me. I was surprised. And essentially all the wealth creation in that time came from just 4% of stocks. And I, for one, won't even bother to attempt those odds, right? That is investing with a 4% chance of finding the stocks that might make it. And even more astonishing, his research shows that 55% of all stocks are losers over 10-year time frame. So you would think that working businesses would generate more income than simply investing in treasuries. Not the case. So what he found was that 4%, like I said, were responsible for boosting the overall returns. 38% just about barely beat treasury bill returns, and 58% failed to return, to beat even those treasury bill returns. And I was surprised until I remembered that I had worked for 3 years at a company where on about $18 billion worth of revenues, we were generating 100 million in net income, and which means that investors would have been better off investing in treasuries even at low interest rates versus investing in our company. So I actually worked for one of those 58% companies for about 3 years. The other interesting thing is that he found that the same conclusion holds outside the US. So this 4% wealth creation rule, as I think of it, I'm beginning to think of it the way I do about Pareto and about mean reversion. Very, very powerful and helps me understand why the index is a good thing and a very powerful concept. I'll go through 6 comparisons just so that you see how the S&P 500 index performs against other investable instruments. And in every case, it's apples to apples, meaning the time period between the two instruments are identical. So this one is against the total US stock market. for a period of around 23 years. So there is a total return difference of around 5 grand and about 20, close to maybe 30 basis points per year in average annual total return. Is it material? Perhaps not, but it clearly indicates that there is some value to owning small cap and mid cap, which is in VTI but not in the S&P 500. And secondly, it also explains why people like Jack Bogle uh, push for owning the total stock market in addition to owning SPY. The next comparison is against RSP. RSP is an equal weighted S&P 500 index provided by a company called Invesco, and it's covering a period of around 21 years. And frankly, I was surprised. I was surprised that an equally weighted index has slightly outperformed the market cap weighted index, but the data is the data. So a case can be made that if I had to do it all over again during working years, it might have helped if that instrument was available, if RSP was available to own something like that in some proportion in addition to the S&P 500 in market cap form. It probably would have lowered volatility without impacting returns, as this chart seems to indicate. In looking at um the S&P 500 index, which is obviously a large cap index, versus small cap and mid cap. So SPSM is a small cap ETF, and this is a period of around 11 years or so, and it's clearly outperformed small cap. It's debatable whether this is a long enough period or not. To me, it is, and it's meaningful. And the um, difference in annual performance of almost 400 basis points per year is quite convincing. On the other hand, it has underperformed mid cap by, about 40 some basis points or so a year. So uh, essentially, slight outperformance by mid cap, significant underperformance by small cap. If you compare the S&P 500 index against the entire world, VT, as represented by VT, again from Vanguard, the performance is overwhelmingly in favor of the S&P index by almost 400 basis points a year. I'm not surprised by it because I really do believe that American companies are the most competitive in the world. So this is not astonishing to me at all. Very few people would be surprised with this comparison against bonds as represented by AGG, very, very large bond fund, spans all the time horizons with, I think, a weighted time duration around 9 years. Um, Very massive outperformance. And this is simply a comparison between the difference between owning businesses as represented by SPY and lending money or loaning money as represented by AG&G. Owning a business is clearly demonstrably better. Last and final comparison against SCHD, probably one of the most successful dividend growth ETFs and my single largest holding. Um, the S&P index is clearly outperformed over the long term. 10/24 2011 was the inception date of SCHD, so it's the full history, 13 years or so. Um, 200 basis points, or just under 200 basis points per year in total return difference. So meaningful. So clearly owning the business and participating in total return beats a purely dividend growth focus. Nonetheless, I own SCHD as part of a balanced, diversified portfolio. And secondly, income generation at my age, 65, is the focus. So I own SCHD. So sometimes you own things even when you don't get the highest total return. So let's summarize. So where ETFs have outperformed SPY, they are VTI, the total US market, the equally weighted ETF, RSP, and the mid cap. In some cases, you can see that even small differences annual performance, like 49 basis points, leads to a 22 grand difference in outcome. But for the most part, in my view, other than the difference with mid cap as represented by MDY, the difference is not material. On the other hand, I would say that where there are differences in where SPY has outperformed small cap, the world, bonds, and dividends, the difference is, a little bit meaningful. Even 186 basis points per year difference is significant. So this is a summary of SPY vis-a-vis other ETFs. The total, or rather the annualized total return since August 1995 for SPY is around 10%, which means you would double your money every 7 years. Standard deviation around 14, so it's not terribly volatile. And a very, very convincing case can be made that the S&P 500 should be in equity portfolios, and quite frankly was the backbone of my portfolio during my working years. My interactions with the S&P 500 index, couple of things. One was it was the key investment during my working years, and in most cases it was the largest component of my 401k. In my taxable accounts, I emphasize dividend growth companies, so that's one set of piece of information. It is also the foundation even in my retirement. So in my retirement, all of my investments are enhanced income type investments, all from equities. Around 35% of my portfolio consists of covered call ETFs that are based on the S&P 500. And when I compare my total portfolio and when I want to benchmark it, the benchmark is the S&P 500. And typically the results show two or three things. One, my total return is less than the S&P 500 since I retired. My income is considerably higher, which is the heart of my strategy. And third, my volatility is lower than the S&P 500. So I wanted to give some of the viewers some ideas about possible portfolio possibilities using the information I've shared and the S&P 500 in particular. So basically what I did was I went to Portfolio Visualizer and I used $10,000 as the initial investment. And Portfolio Visualizer covered 9.5 years. That's the maximum they'll allow you to do if you're a free user from January 15th through June of 2024. And I'll walk you through the table in just a second, but just one reminder that IVV and VOO are cheaper than SPY. And the Sortino ratio is basically the same thing as Sharpe, except that it only looks at volatility on the downside, because that's when it impacts investors the most. Very few of us get worked up when volatility is on the upside. It gets stressful when it's on the downside. So higher Sortino is better than lower Sortino. So here are the scenarios as I see them. So the columns are obviously the ETF, the ending value of $10,000 9.5 years later in June 2024, the cumulative growth rate, the standard deviation, the volatility, if you will, and then the risk-adjusted return as reported by Sortino. So the S&P 500 would have gotten 10,000 would have got to 31,343. I then did an even SPY and RSP, and RSP is the equally weighted market index. It actually had lower returns and a higher standard deviation and a lower Sortino. So that was a surprise to me. So I don't know that that actually adds value. Then I just did a 50-50 with SCHD. So SCHD is a dividend growth ETF, and that combination of SPY and SCHD is a proxy for my portfolio, my total portfolio during my working years. And that would have returned less than SPY on its own, with a slightly lower standard deviation and a somewhat similar Sortino. So I'm not sure that it led to any outperformance. I had thought it might, but it did not. Then I came up with one that was built on both. That is the index, and then on one extreme to the left of it, if you will, is SCHD. By left, I mean less emphasis on total growth or total return. And then SCHG, which is pure growth, is the growth component of the S&P 500. So I'm calling it the market cap plus dividend plus growth. And it actually beat SPY on its own, and has a higher Sortino. So this one, in my view, has legs. Then I did one that was growth. So I replaced SCHD with QQQ. So it's essentially the S&P 500, the NASDAQ 100, and then SCHG, which is the growth component of SPY. And that had a fairly significant outperformance, right? 10 grand on 10 grand in total return. It's quite significant. And the Sortino ratio is higher than owning SPY by itself. So I'm a little bit surprised. And then the last one I call super growth, which is the exact same thing as the previous one, except I added VGT, which is the pure information tech ETF from Vanguard. And that was even a higher performance with a higher Sortino. So I was a little bit surprised at not that necessarily the higher returns with the last two combinations, but the fact that they had higher Sortinos. So I just wanted to put this out there so that for people mid-career, you can look at this information and make, decisions regarding your portfolio. Coming to the end, I always remind myself that success is the sum of small efforts repeated day in and day out. And this is more for me than for you, dear viewers. Um, so how do I use the S&P 500? Well, it was the backbone of my portfolio, as I've mentioned a couple of times. In my 401k, even in my RAs, it was pretty much sometimes the only holding. It is approximately 35% of my portfolio, or the basis of my covered call ETFs that I own in my portfolio today. I have a very detailed presentation on my current portfolio called the Details and Design of a Passive Income Investor. It's available on YouTube if you want to know more about my current portfolio. I encourage everybody to either get started on the investing journey, or if you are, boost it up some. And as always, try not to be tactical, but make decisions based on a strategy, ideally a documented strategy, and after tremendous due diligence. Use information like the information in this presentation not to copy, but to use as triangulation, as input into your process so that you make decisions based on the needs of your family, your life, your vision, your goals. All the best, guys. Bye-bye.